Hey everybody, good afternoon and welcome to the Supply Chain Solutions Weekly Ship Show. Today's January 27th, 2022, and this is episode number 4 in our weekly educational series that keeps you informed of the changing market conditions as we work to crush supply chain complexity in a time of disruption and uncertainty. As always, it's my pleasure to welcome my Ship Show co-host, Jason Brand, our Director of Business Development, who joins me each week on our broadcast. And finally, my name is Anthony D'Ambrosio. I'm the Vice President of Business Development at Supply Chain Solutions, the company that always delivers value quickly, affordably, and flawlessly. And as usual, we'd like to thank our amazing Director of Marketing, Vanessa Fry, for producing today's show. So folks, I know last week we interrupted our broadcast a couple of weeks ago with an emergency supply chain alert regarding the port shutdowns in China and some of the slowdowns on the West Coast because of COVID outbreaks. And then last week we did our freight market roundup to go over the global freight market conditions. But this week we want to get to the container shipping's outlook for 2022 and what we can expect. So what's the shipping outlook for 2022? And I think most importantly is we don't have a crystal ball to foresee shipping in 2022. However, I think analysis and forecasters are predicting some future scenarios for this year that I'd like to go over. So looking ahead, we expect these market conditions in shipping to persist and worsen until the first quarter of 2022 and beyond. Not just because of Chinese New Year and the Olympics being held in Beijing starting on February 4th, but because of the continuing and growing issues with hyperinflation, the central banks, the pandemic, and the continuing bottleneck challenges in the manipulated market conditions by the container ship cartel to already disrupted global supply chains. Many economists that I study assume that backlogs and elevated shipping costs are likely to persist at least through the middle of 2022. And a reason for that is that there are no immediate solutions for the underlying supply and demand imbalance at the U.S. ports that are available. Now, on the demand side, high household savings in the U.S. and Europe should support consumer demand. But the composition of spending is likely to rebalance towards services in 2022. And on the supply side, supplier delivery times remain lengthy, and there is little visibility into when capacity constraints, including landside bottlenecks and trucking and warehousing, will diminish. So this means moving forward, businesses like yours need to further adapt to flexible supply chains and enhance their supply chain forecasting. I mean, think about it, folks. Never had the container shipping year begun on such a high note in terms of pricing. The Shanghai Containerized Freight Index hit a new record last week. It hit a new record in the last week of December, up 76% year on year, topping 5,000 points for the first time. And as of this past Sunday, there were 101 container ships waiting for berths in Los Angeles and Long Beach this past Sunday. So it was very close to their peak. Now, I'd like to talk about Trans-Pacific spot rates. So the Trans-Pacific spot rates quoted for this month are higher than in December, which were higher than in November. And annual contract rates are up sharply in 2022. And according to the latest data from Exenta and Asia US contract rates, they are up 122%. And I'm going to say that again. Those rates are up 122% from 2020, pre-COVID, with bids in early negotiations for 2022 contracts averaging almost $5,700 per FEU for per 40-foot equipment unit. So I think the overwhelming consensus is this year will remain extremely strong for ocean carriers and extremely expensive for cargo shippers. It's sad to say, but there are at least 6 big known unknowns that I want to talk about. The first is, how will Omicron and future variants impact U.S. consumer demands, as well as affecting effective shipping capacity and factory output? I think, as I said, we don't have a crystal ball. We don't know what other variants are going to pop up. And I think everyone has recently heard about the stealth variant, which recently was in the news earlier this week. So again, that's an area we just don't know, how this is going to be managed. The other thing is, how long will U.S. import demand remain after the stimulus is withdrawn? Demand was very strong because of government stimulus over the last 2 years, and now that it's been pulled back, how is this going to affect demand? Another thing that I think is really important to point out is how much of rate strength is driven by higher import demand versus how much is driven by lower effective shipping capacity, given vessels tied up in congestion. So think about all those ships all over the world, whether it's in, the port of Genoa or La Spezia in Italy, or it's in the port of Ningbo, okay? Or for containers, for vessels in the port of Savannah or off the West Coast. All of these vessels sitting at the anchorage tied up, that can't get a berth to do their business, to unload and take on containers, drives congestion, and it affects all of the shipping capacity all over the world. I mean, last year we reported at the end of December that pre-COVID, the average dwell time at the anchorage in the San Pedro Bay off the West Coast ports was only 3.5 days, meaning when the vessel got to the San Pedro Bay, it only took about 3.5 days to dock. Now it's taking 14.3 days for a vessel just to find a parking spot, or as we say, a berth. The other thing is that we need to pay attention to is, can a new West Coast labor contract be signed without disruptions to terminal operations? Now, folks, this is a big fly in the ointment. We remember during the last ILWU contract negotiations in 2015, they did not totally stop work, but they really throttled down, their gears, and they slowed down, and things came to a crawl. It was just a terrible situation. So this is something that's going to require constant monitoring by all of us at SCS to see how this pans out. And if a labor impasse is averted and import demand falls and congestion eases, will the liners, in other words, the container ship cartel, will they have the discipline to remove vessel capacity and keep rates strong as they did during the lockdowns in the second quarter of 2020? So that's another big factor that we really have to watch, okay? We're already hearing about blank sailings that are going to be implemented beginning in the second quarter of this year, and they're happening right now. So that's another big thing. And then one of the last things is, could the China-Taiwan geopolitical tensions devolve into a military action? Despite what we hear about Russia and things going on in the border of Ukraine, I study these geopolitical events a lot, and I don't think that they're going to have a conflict in Ukraine, even though it's reported differently on the news. That's just my gut instinct. But I think the big picture view on rates is that volumes will continue to be very high this month prior to Chinese New Year, and volumes will pick up again after China resumes work. with U.S. importers seeking to restock depleted inventories during the spring, after which the 2022 peak season will keep rates elevated well into the fourth quarter this year. So, in my opinion, it's just that there's no strong expectation of significant improvements for cargo shippers. Right now, it's still a shipper's market. The container ship lines have all the cards, and until the underlying demand diminishes, and that does not look like it's going to happen anytime soon, it's still going to continue to be a shipper's market. And at the very far end of the spectrum is the Deutsche Bank team, led by UK-based analyst Andy Chu. And Andy Chu is a guy I follow. And this is really interesting. You have to listen to this. The team's 2022 estimates of earnings before interest, tax, depreciation, and amortization for Maersk and Hapag-Lloyd are more than twice the consensus average. Think about that. And according to Andy, 2021 was the best year for container shipping on record. But we're hearing and we think that 2022 will be materially better. And the Deutsche Bank predicts that the two carriers' average freight rates will be up 30% this year versus 2021. So it forecasts that Maersk's 2022 EBITDA, their earnings before interest, taxes, and amortization, will be $34.6 billion in profit. That's more than the whole industry made in the last 10 years. That's up 43% from 2021. And Hapag-Lloyd's 2022 EBITDA will be $20.4 billion. That's up 56% from last year. So, folks, those are some mind-blowing numbers. And on the flip side, we know that freight rates have been propped up by the U.S. stimulus, which we know is now over. But as a result of this, I believe that consumer demand could fall and inventories will not be stocked to the extent predicted, and the port congestion will clear. So that's the flip side. On one side of the coin, we're hearing the market conditions and the demand is going to be strong, and we're going to have disruption and bottlenecks and volatility in the pricing all year long. But then there is another side to the story which says, hey, demand could really fall off because of so much inflation, and God forbid we go into really super hyperinflation, it's going to be crazy. So I'd like to point out that retail sales were abnormally strong in 2021, and I believe that we will start to see a strong regression towards the long-term trend line for retail sales in 2022 with no additional stimulus, student loan deferrals ending. And that's likely to shift, signify a shift of the pandemic as an endemic disease. So, I think if inflation continues to skyrocket and consumer demand should and will fall dramatically. And equally important to point out is that retail inventory sales ratios are historically low, but this ratio was declining pre-COVID, and inventories are now far above their historical trend line. So given the uncertain nature of the COVID era demand, I question how much retailers would add to inventories this year. I mean, my personal opinion is that we're going to have to wait and see. And this calls into question the arguments that retail inventory restockings are going to be a major source of freight in 2022. So we just don't have clarity. Now, there is also another scenario in which global spot rates fall from $9,300 per FEU as measured by Drewry, which is the World Container Index, at the end of 2021, and they fall all the way down to 2,000 per FEU by the end of this year, which would be phenomenal, but I am skeptical. Think about it, folks. Right before the pandemic started, to bring a 40-foot container from Hong Kong to LA, the rate was $2,100. Now it's somewhere around $14,000, maybe a little higher, depending on your multiple carrier and rate flexibility and your leverage. Now, my opinion is that this scenario is much more likely in 2023, but nonetheless possible this year. So even though this may not happen until 2023, there exists the possibility that this could happen. And I estimate that much of the extreme tightness on container shipping rates, no matter where you're shipping to and from around the world, can be attributed to supply chain inefficiencies, as true underlying demand was just 3% greater than the incremental supply. So as is the nature with traffic jams, when the accident is removed, normal velocity patterns materialize very soon. But when it finally does, we do not expect this time to be different. Now, in this case, this time it's different view is that ocean carriers will counterbalance the headwinds, and a drop of demand and or capacity unlocked by clearing congestion by blanking or canceling sailings to artificially bring the capacity in line with the demand to prop up the rates, which was a strategy carriers successfully employed at the beginning of the pandemic, is going to continue to happen. And my opinion is, if ultimately markets do not fall meaningfully, once it becomes implausible to blame congestion on COVID, we will readily attribute a greater weight to change industry structure, as likely will regulators. But I think it's still too soon to tell if the industry has been permanently transformed, but I think there are some indications. Now, in addition, there are a few things we're going to have to monitor throughout 2022. They are COVID, port labor negotiations on the West Coast, and a possible Taiwan gray swan political event that we already talked about. So let's just touch on COVID real quick. I mean, I think as the year began, essential services in places like New York City, as well as air services nationwide, were being curtailed by large numbers of workers out sick or testing positive for Omicron, which has rapidly spread. And meanwhile, China continues to pursue its zero COVID policy, in which large swaths of the population centers are locked down for a small number of cases of Omicron, okay, or Delta. And as Jason and I spoke about a couple of weeks ago, the city of Xi'an, with a population of more than 13 million people, had been on a strict lockdown since December 22nd due to cases of the Omicron variant. And Omicron cases have just been reported again a couple of weeks ago in the port of Ningbo, which caused a partial shutdown, and some of the other major ports. And yet there is another outbreak affecting the Yangtze River pilots operation. So all those vessels transiting down the Yangtze River, you need to have a river pilot to basically steer the vessel along with the master of the vessel. So again, it's another really big issue. So if a much more transmissible Omicron variant takes hold, or this stealth variant takes hold in China, and the country sticks to its zero COVID policy, it could lead to widespread factory closures, as we saw in the initial outbreak in Wuhan and the various port closures last year and this year. So, as Jason and I mentioned in our emergency alert a couple of weeks ago, we are seeing this unfold. And again, this is something that we have to monitor. Again, another great thing that we want to point out is the port labor contracts. The international longshore and warehouse union contracts with the West Coast terminals expire on July 1st. Now, the previous round of negotiations in 2014 and 2015 didn't go smoothly, as I mentioned. So disruptions to terminal operations led to backlogs in Q1 of 2015, similar to levels in the earlier part of this year. So if the negotiations go south and no agreement is ratified, then all bets are off. And the West Coast port operations will come to a standstill. So we're monitoring this very closely, and we will keep you informed of the ebb and flow of these negotiations. Do we think it's going to come to a standstill? No. I think it'd be sort of a national security issue if the union totally locked down the ports and labor stopped. So, there may be threats, but again, there's going to be something we're going to have to just watch. And then lastly, Taiwan. The other big X factor for container shipping, giving America's exceptionally high dependence on Chinese exports, is the geopolitical tensions over Taiwan. I saw a video last week, last Thursday, as a matter of fact. Wang Ming, which is China's foreign minister, warned that America's encouragement of Taiwan's independence not only puts Taiwan into an extremely dangerous situation, but also exposes the United States to an unbearable price. So there was a lot of rhetoric going on here with this announcement. And, I think it's a lot of bluster right now, but my opinion is, and I hate to even open up the door to this Pandora's box, but clearly the Chinese have coveted the island of Taiwan for years, and tensions have been rising for a long time. So any overt military action on the part of the Chinese would be very bad for all things shipping. And it would likely lead to sanctions by the international community and a reduction of the flow of goods, especially in the Straits of Formosa. So again, this is something we really have to watch. And lastly, just want to touch on a couple of quick things before Jason and I take some questions. But something we need to look at is that right now for this year, we should consider what are the 4 leading supply chain trends in 2022. And I think it's important to note that supply chains saw massive shifts in 2020 and 2021 as the COVID-19 pandemic and its effects impacted countries and businesses around the world. So what are the supply chain trends for this year? Let's take a look at those major trends. First one is digitalization. The pandemic drastically accelerated the digitalization of customers and supply chain interactions by 3 to 4 years. Okay, so within just a few months, I predict that digital transformation will impact small and medium-sized enterprises. This is what we call SMEs, okay, small and medium-sized enterprises most of all. And this is going to enable companies to access advanced software, such as data analytics, ERPs, and inventory management systems. And moving forward, I think businesses are going to further focus their efforts on building better digital-first interactions with customers. And at Supply Chain Solutions, our vision is to accelerate digital logistics for our SMEs and our large clients through digitalization and our new client portal powered by Project 44 and MuleSoft. And it does just that. Our second trend to watch is the changing consumer patterns and the inventory management. Now, during the pandemic, many international trading companies moved their inventory management from just in time to just in case, showing an increased demand for visibility and predictability in global supply chains. It is, however, too early to tell if the trend is here to last. A study I just read last night found that 39% of organizations expect to shift from just in time to just in case sourcing and manufacturing in the coming years. Now that's up 29%. 29% of the organizations pre-COVID. But when bottlenecks ease and I guess what I'm trying to say is when some of these bottlenecks do ease, some companies may revert back to the old, more cost-effective, just-in-time inventory management system that they're so accustomed to. And that's a strong possibility. But again, I don't think that that's going to happen. And lastly, just our last 2 points to get through this real quickly: sustainability. With the COP26 climate change conference just completing in Glasgow several weeks ago, I think there's a big push throughout the industry to drive sustainability into supply chains and its supply chain solutions. We are proud to partner with Maersk as well as other carriers who have taken a clear stand on sustainability. And for instance, Maersk just announced that we'll operate the world's first carbon neutral liner vessel in 2023. And we see a series of these vessels coming into the rotation by 2025. So they're going to replace a lot of the older vessels, generating an annual CO2 emission savings of around 1 million tons. And lastly, local is the new global. That's the last trend. Local is the new global. So during the pandemic, when access to global supply chains were disrupted, some companies in the logistics industry found new and significant opportunities by sourcing locally instead. So by gaining more benefits, it is expected that the local sourcing might grow within the following year. And we're seeing that now as a lot of companies move away from China and they start to get into near sourcing and resourcing and best sourcing. This is going to be a big trend as this year continues to unfold. And this way, companies can avoid the risk of economic and political challenges to gain better control over their delivery times. That's been just such a big challenge for everyone. So staying ahead of the trends and forecasting supply chains in 2022 can help limit disruptions, folks. And over the past year, or I should say years, we have learned a lot from the severe changes from COVID-19, and moving into 2022, flexibility is going to be a top priority for your supply chain management. And we want you to know that supply chain solutions will be there to provide the hand-holding and the attention to detail that companies deserve as we navigate these unforeseen disruptions and the turbulent waters of supply chain madness in 2022. And that's our outlook for 22. So with that, we're going to turn this over to Vanessa and Jason to see if we have any questions about our outlook for this year.